So we look forward to some introductory comments, or if you want to allude to part of the particular update,
Sure.
then we'll have plenty of time for interaction.
Yep.
So welcome back.
Thank you, Mr. Chair. I just want to acknowledge my colleagues who joined me today. On my right, Dominic Stevens, who's our Principal Economic Advisor and Deputy Secretary. Dom will be leaving us in a few months, so I'll put on my record my thanks for what I've learned from Dom in my short time in the role. And also Dom will be overseeing the long-term fiscal statement, which will be released in around September. Which we'll be looking forward to coming back to the committee to discuss later in the year. And on my left, Struan Little, and Struan is moving to a different role in the organisation, having overseen 9 budgets in a row. I did 6 in a row and that nearly killed me, so here's my thanks for his service. And also Kim Martin, who's Head of Debt Management, Jane Winfield, who's Chief Government Accountant, and Peter Gardner, who's Manager of our Sting.
Oh, thank you. Welcome.
Just to make a few comments and then get into the conversation.
Yes,
firstly, a little bit of the backdrop to the economic forecast. The first point is New Zealand, between 2022 and 2024, went through a protracted economic downturn. In terms of GDP per capita, it fell by 4.8%, which is actually bigger than the fall through the GFC. So that's the sort of starting point for the economy that, in response to the monetary tightening that the RBNZ undertook, we went through a very significant per capita recession. The economic recovery is underway. It's very much still, I think, take as a 2-speed economy. In the earlier session referred to the strength that's coming through in the primary sector. That's less so in some of the more domestic-facing industries. So through the forecast period, that recovery is driven by both the reductions in interest rates that we've already seen from the RBNZ and our expectations of some further reductions, together with a generally continued good performance through the export sector. One of the key judgments around our forecasts that no doubt we'll come back to in discussion is the impact of trade tensions. We can say a few things. What's happening is unequivocally bad for world growth, and it's unequivocally bad for New Zealand's growth. So in terms of our global growth outlook, we're looking at GDP globally about 2% over the next 2 years, and that's well down from the 3.3% average over the last couple of decades. Now, within that, in our forecast, there's some judgments that we've had to make about the channels by which those trade tensions transmit themselves to New Zealand economy, investment uncertainty, impact directly on exports, the impact on global inflation and therefore price pressures here. And we'd say, look, there's still a bit of uncertainty about timing, magnitude of some of those influences, and we can talk a bit more about that with the committee. The backdrop of that economic expansion over the next few years does flow through into significantly higher levels of tax revenue for the government's books. We do have a box in the BFU that talks about how our judgments about the tax to GDP ratio have been shifting downwards since 2022, i.e. that's the sort of underlying tax base absent of both administrative and policy and economic changes. Now, given those shifts and downward revisions, we still think there's some uncertainty and potentially there's some more downside risk ahead of us. When we turn to the expenditure side of the books, the key drivers, I think, are twofold. One is, the government, as you heard through the Minister this morning, has some pretty tight operating allowances that are essentially working down the expenditure to GDP ratio through time. There are a couple of big fiscal headwinds that we're seeing through the accounts. One is New Zealand superannuation. So this year, New Zealand superannuation costs are increasing by about $1.4 billion. That's essentially equivalent to the net cost of the government's budget initiative package. Over the forecast period, essentially a number of New Zealand superannuitants increases by about 125,000. So that's a broadly equivalent to
In 4 years.
population of Dunedin. And we'll have over 1 million recipients in New Zealand superannuation by the end of the forecast period. So it's a very significant increase. Allied with that is the increase in finance costs, which is consequent both on continued rising levels of debt and also of interest rates. So finance costs were about 0.5% of GDP in 2021. We estimate it'll be about 2.5% of GDP by 2029. It's quite a big shift upwards. Turning to investment, one of the things I think is quite striking about our forecast is there's a very big government investment program built into the accounts, and there's a nice chart, I think, on page 53, graph 2.14. So roughly in the forecast period is about $80 billion of additions to infrastructural or capital assets across governments. That's well in excess of what you'd expect with smeating depreciation. The combination of large but declining operating balance, operating deficits, and a large investment program means that we are borrowing a lot. The year just ended, we've borrowed $43 billion, which is our second biggest bond program ever. Next year we go out with $38 billion. Roughly at the moment about 60% of our bonds are picked up by foreigners. So I think that it's a message a bit about the maintenance of confidence and credibility of the fiscal stance is really important, given essentially we're heavily reliant upon foreign capital to finance the public accounts. And finally, like every forecaster, they're going to tell you there's risks to the forecasts, and we see risks on both sides. But as we say in the document at the moment, we see that the risks are skewed more towards weaker outcomes than we are projecting in these forecasts. And that's largely a consequence of the global environment that we're working in, which is partly the trade tensions issue that we've talked about, and also wider geopolitical tensions. And, we've just seen in recent days some of the economic implications of the current outbreak of hostilities between Israel and Iran. It's just reflective of the, if you like, the polycrisis that faces governments, I think, globally at the moment. So I'll just stop there, Mr. Chair, and open up for
thank you.
questions.
Thank you, Mr. Rennie. We're going to go to the Honourable Barbara Edmonds.
Thank you very much, Ian. In 2025-26, the super fund contributions do decrease dramatically, around 879 million in the previous year to 103 million. Now, your explanation is because, I understand, is due to movements and calculations as set out in Section 43 of the Super Act. What does that actually mean in practice, and what are the future implications if this trend is likely to continue, noting that we know that super costs are going to go up. We know that in 2060 it's going to be around 7% of GDP. So does Section 43 compel the government to reduce or stop, or actually the contributions have to go out, or is it just merely that's how you calculate it?
Look, I'll have a first crack at that. I think firstly, the Act specifies
how you calculate the contribution.
How you calculate. As we've seen previously, governments have taken choices both to
reduce
or to suspend in the time of the previous national led government. At other times, I think in the Labour-led previous Labour-led government, I think there were some contributions that were shared over and above the contribution. So there are choices,
yes,
for governments beyond what's in the Act. It is, as you say, around calculations. Obviously, one of the interesting things about these forecasts is that we have 1 year in which there's a slight withdrawal using the Act's methodology. But I think that's sort of telling us slightly more when we get into the 2030s. That's when you will have consistent withdrawals.
Yeah.
And that's a feature, not a bug. So that's essentially saying, the fund itself will still keep on growing through to, I think, about 2050, 2060. So it's not the fund in absolute terms is coming down, but they actually, to essentially help finance the rising costs of super, some of those funds will be coming back to the Crown and therefore reducing the amount of debt that the Crown would otherwise have to raise to finance those costs.
Because I understand when Sir Michael Cullen set up that fund, that they forecasted that it would distributions would start to happen around mid-2030s. That's kind of what I understand. Yep. And that section of the Super Act actually reflects that. That's how you sort of calculate it, is based on a 40-year sort of period.
Yep.
So if the government stops the contribution or reduces the contributions, how does that make sense when this super fund is, I think the last quarter was the last year was the #1 super fund in the world for returns? It doesn't quite make sense to me as to why you would decrease or start to withdraw from the fund slightly earlier if you're not compelled to. I guess it's a choice, right?
So the formula aims to smooth the payments that New Zealanders make to sustain New Zealand superannuation plus contributions to the fund over 40 years. So yes, the very strong performance of the fund in recent years is one of the factors that has meant that the formula will soon tick over into withdrawals to keep those overall payments the same, or roughly the same for New Zealanders over those 40 years. So the formula is affected by the performance of the New Zealand Superannuation Fund. The more it grows, the more that we're able to withdraw to sustain the payments. Obviously, super payments relative to GDP, which is in turn influenced by the ageing of the population.
So this might be behind your question, but I think, certainly one of the choices I think that face governments going forward in how do you finance the demographic transition is what is the role of New Zealand Super Fund, and is that same as reflected in the current legislation, or could you use it, differently? And I think that is a choice. For example, you could have higher contributions going into the super fund, but you then have to recognise that essentially you're leveraging up your balance sheet. You're essentially borrowing, and then you're sort of assuming that strong record of returns, essentially from international financial markets, will continue in a similar way as it has in recent years.
So effectively then from the 26, 27, therefore, the distributions from the super fund will start to occur. Is that
no? If you look at, I'll just get I can find my page. It's actually in the. If you go to the Fiscal Strategy Report on page 18, this year the government is not putting money in directly to the super fund, but is putting money into Elevate. There's $4 million in 26, 27, minus 32 in 28, and then 63 in 29. So essentially, I'd say the pattern is essentially small contributions either way over the next few years, and it's not until you get into the 2030s, as you were saying, that you'll have outflows as indicated by the current methodology.
So if the government did continue to keep in the same amount which they had the previous year of 879 million, what was the forecast last year around how much that would, what would actually happen if that continued to be invested? That's right. You can come back to me because we've been in last year's.
Yeah, we can come back to you with that one.
Sorry, I've got one more question.
Yeah, no, that's all right.
And then, sorry, just going to the KiwiSaver contributions. So effectively, they've been halved. Both the KiwiSaver and the Super Fund came through Sir Michael Cullen under a Labour government. The KiwiSaver contributions, have you actually forecast without the contribution increases from employer and employee? Because obviously your advice shows that there may be lower wages as a result of a total REM package because employer contributions may go up. Do you know what was your assumptions around those that would have to those employees that would keep down at 3%? You have a number around that because you must have in order to calculate the government savings.
Look, I think can we come back to you in terms of that? I mean, I'm also thinking that might have actually come from IR. So you have IR this afternoon. So, but certainly if you don't get it from them, we can come back to you on that.
Okay, thank you.
Okay, thank you, Barbara. I'm going to go to close, Robert.
Kia ora. I was wondering if you could unpack for the committee what your understanding is of our current situation with the structural deficit, where you think that comes from and the options on the table available to us and the trade-offs inherent in all of those.
So in the BFO, we estimate that the we're talking about structural fiscal deficit, right? Structural fiscal deficit is roughly.
We'll deal with the infrastructure deficit later.
Sorry?
We'll deal with the infrastructure deficit.
Yeah. Well, they kind of are related, but about 2% of GDP.
Yep.
Roughly. And that's sort of been where it has been for several years, right? So it hasn't been getting worse, but it hasn't shifted. And effectively, where we were, pre-COVID, we were much more immediately pre-COVID in a sort of a much more balanced structural position. So through the COVID and immediate COVID period, we've run this big significant structural deficit. Now, the options to governments about how do you close that? And firstly, the nature of structural deficit is not going to close itself through economic growth. That's part of the definition of what's meant by a structural deficit. So you're facing choices about
How we consolidate.
Raising revenues or reducing expenditures effectively.
And to that effect, the trade-offs that I was trying to pull out of you, just to unpack a bit of that, kind of what do you see as the trade-offs for that revenue versus spending side?
Well, I think firstly, the point is, I think a government has to think about the overall outcomes that governments are trying to achieve. So, issues about whether the environmental outcomes, distribution outcomes, essentially are important around those choices. I think for us, we'd also say, as a Treasury, because we were focused on both economic and fiscal outcomes, we'd think very carefully about what are both the fiscal and economic consequences of making changes. So if I'll give you an example, a ridiculous example. So don't take me literally. If we said let's close down primary schools, we could save a lot of money.
He said it.
Don't give him an idea.
That would obviously
We're opening more schools
because we think human capital is really
Keeping
important.
private
That's a
schools
source of productivity growth. That's something that we wouldn't be stumping up as a policy advisor, right? And similarly on the revenue side, we've given advice previously around how you might change the tax base, for example, and choices in that vein. And we're on the record about having slightly different views on wealth tax versus capital gains tax, for example. That's because we see there are different trade-offs to kind of the outcomes that you can generate.
I guess the point that I'm kind of trying to get to here, and this is reflected in obviously tons of international research, is that kind of consolidation through particularly expenditure side and bringing back government spending does have quite substantive distributional impacts. That is, it can potentially increase inequality. And obviously you guys have made recommendations to the Minister time and again about what the operating allowance should be if we just want to keep business as usual, and made recommendations or gave advice to the effect that the kind of cuts that we are seeing represent, I can't remember the exact terminology used, but a structural change or a foundational or fundamental change to the way that government operates in this country. So could you just unpack what that actually means in real world terms a little bit?
Well, real world terms, I mean, I think firstly, we've looked quite hard at fiscal consolidations globally. And we've looked at countries where they have stuck. And I think there's a few things that happen is they're sustained over actually quite long periods of time. So the average fiscal consolidation takes about 9 years. So they're the consequence of quite consistent and deliberate, but not precipitate policy action. So you're not slashing benefits or throwing over tens of thousands of people. So, and I think we'd say as advisors, taking that sort of long view is beneficial if you can afford to take that time. It's also pretty clear that most fiscal consolidations are achieved through a mix of both expenditure reductions and revenue measures.
Most.
And
not us, but yeah.
Oh no, well, even I mean, if you look at our forecast, for example, and why does the operating balance go to zero? Roughly about that's 3/4 expenditure. About a quarter is revenue, because our good friend fiscal drag kicks in and we get the tax to GDP ratio, kicking up. So that comes down to choices for governments about not. It is an and that's certainly the advice we give, and that's also why the advice we're giving to ministers is why you want to think about how you use your balance sheet. We clearly know that New Zealand needs to invest and invest well, but not all of that investment needs to be financed through new debt as opposed to recycling existing assets.
I'll get to debt if I may return later, but I just really, I guess, wanted to unpack that in some total with the budget package that you guys, that we have. What are the distributional impacts of that? Do you project as Treasury that will increase or decrease inequality?
So we don't have a measure of inequality, but we do have budget impacts on child poverty, and they're generally sort of very small. So child poverty is forecast to remain at around the current level going forward, and the impact of this budget is really quite small.
I mean, we also look at what's the impact of this budget package on the public sector workforce, and so the budget package itself generates about an additional 5,300 jobs.
And do you have a sense of the cost, whether it be in real economic or in fiscal terms, of child poverty or of deep inequality when it comes to particularly growth?
So there are.
Is child poverty good or bad for growth?
Well, child poverty is certainly, probably bad. It's certainly something that so the 2022 Wellbeing Report certainly identified some of the interrelationships between education levels, for example, and productivity outcomes, and therefore economic growth going forward.
Let alone the real world impacts. So if I may, just on debt. Cool, Mr. Chair, thank you. Do you guys see that all debt is the same, taking on debt, for example, to, fund tax cuts versus investment in productive infrastructure?
I think broadly, I'd say two things. One is the starting point is that the assumption should be that government revenues should cover operating expenses. So the year-to-year impact. I think the question about borrowing for infrastructure or capital more generally is a bit more complicated. So in principle, you can say, look, there's a value to borrowing because the value of particularly long dated assets, so if you think you buy a frigate and it's here for 30 years, or you buy a hospital which is here for 75 years, those assets can be used by the community through long periods of time. Therefore, there is some sense to smooth the costs of that through time. So that is the argument, I think, classic argument for borrowing for those big assets. The challenge and that's been part of Treasury's advice. I think the challenge in the investment space is that the boundaries between what is operating expenditure and capital is not always clear. And I think the other point, which we've talked about previously in our advice, is that as an investment system, we haven't always made good investment decisions. Now, there was quite a lot of work that went on under the previous government, and that's continued, particularly through Minister Bishop, to essentially have much better use of business cases to ensure that the returns on investment, whatever they are, economic or social, are being delivered. I'd say, look, there's a really progress has been made, but it is a work in progress. And one of the challenges for us is with the size of this capital program over the next few years is ensuring that delivers value. It's a very big program.
Okay, I think we'll stop there and we'll go to, we're 25 minutes in, so we'll go to Dr. Megan Woods, and then we'll go to Dr. Deborah Russell, and then we'll come back for any others.
Thank you. And thank you. Look, just really interested in the new risk in terms of investment boost. So page 89 of the BFU. As we indicated in earlier session, broadly supportive of the approach. What we do have some concerns around the sustainability in terms of it being uncapped and non-targeted. In terms of just really keen to understand some of the modelled impacts and that went into the Treasury work on that, and kind of what the range you're seeing in terms of what could be applied for under that. We know that asset classes that don't qualify for depreciation in normal circumstances are included in this regime. So really interested to hear Treasury's analysis on that.
Yeah. So I mean, the first point I make is in terms of the advice and policy, both ourselves and IR work very closely, and a lot of some of the issues that you're talking about some asset specific issues, our colleagues in IR lead that. So I'd encourage you to kind of ask those questions. I think if we step back slightly, I think one of the pieces of advice that officials were giving to ministers is when you look overseas at similar schemes, some of those are more targeted towards particular kinds of investment. Now, I think our view was New Zealand is our capital intensity is low, so in a sense of we need to raise it across the board. In addition, globally, at times there's been cottage industries established to redefine investments in a way that's advantageous to particular taxpayers. We didn't actually think that was essentially what would be constructive. On your point about let's think about the uncapped nature of your question. I think there's two things. One is this is we're really assuming there is quite a big uptick in investment through the forecast period. Obviously, if there was a bigger behavioural response, you have to ask yourself, is that the overall level of investment rising, or is that investment being pulled forward? And those judgments are quite important in terms of how you then think about the fiscal impacts, because if you're moving just things forward, it has a hit on your accounts, but over time, you're probably less worried. And then actually, if you're raising the overall level of investment, then you're thinking, well, you're presumably getting high profitability, more job growth, etc. on the other side. So it's and I'd say officials see risks on both sides. So it's we don't see the risks necessarily stacked in favour of the upside. There are 12 months time we could be having a different conversation with you about why wasn't there the pickup that we expected. So I think we feel reasonably kind of comfortable around the judgment about where the policy advice landed.
Yeah, just going to add that. I mean, there is a fairly wide range in the literature of the sensitivity of investment activity to this type of policy. We pick the midpoint as the estimate. IR and Treasury pick the midpoint as the estimate that's incorporated into our economic forecasts.
So will Treasury be tracking this and interrogating the data as it comes through from IR in terms of whether we are seeing an uplift in the kinds of assets that we know underpin increased productivity? The kinds of things that I think everybody, no matter what side of the house, sit on, that they want to see kind of our businesses investing in, or will we be seeing kind of more kind of run-of-the-mill expenditure that there's questions about whether or not that is actually linked to productivity. I mean, will there be that analysis going on? The other is the types of businesses that are able to claim under this. One of the concerns that we have is that there will actually be some of our businesses that will probably be most, could really benefit and lift their productivity and their contribution to our economy a whole lot more, but simply are in a position at the moment where they're not in a position for any capital investment, even with these kind of measures. So not saying that it's bad because of that, but just that tracking and measuring the impact.
Look, and your point is, and I think I might have said this last time it was at a committee, look, there's no silver bullet around higher productivity. You know, when we look at the literature, it's around doing a lot of things well. So your last point is a valid one. If you're a very cash constrained business, you're probably not going to be investing anyway, right? And so the questions are for those businesses, what's important in the policy settings, and this is probably not the right instrument. So we would certainly say this is certainly not the silver bullet, but it is one of, I think, a suite of interventions that government needs to be thinking about in coming years.
Yeah. And I mean, I think we can all say at 1% growth over 20 years is the forecast, that there's going to have to be complementary things. It's
Absolutely.
part of a jigsaw puzzle. Sorry, just a slightly different question to finish up on is whether Treasury did any analysis on the impact of the pay equity changes on economic growth? Yeah.
Not directly. We've done some estimates in terms of what pay equity changes had things like
Sorry,
wage.
I dismissed that.
Not directly in terms of pay equity itself, but we've done some estimates in terms of what might happen to the tracking of wages through time, and then in consequence on that, building that into our models in terms of what happens to overall growth.
Okay.
But not a detailed distributional impact.
Okay.
Analysis.
So I guess my question is why? Why wasn't that detailed distributional impact done in terms of, because we know the multiplier effect, that kind of level of lift in wages of some of our lowest paid in the economy, that the kind of stimulatory effect that could have. So why didn't Treasury do that analysis?
There'll be a couple of things. I mean, one, the pay equity legislation is still in place. So what the change has been a narrowing of the criterion there, but the fundamentals are still there. So it depends on the scope of that. And the second is, I think you have to see it in the context of everything else that's going on in the budget as well. And in terms of the distribution, and we just talked about investment boost, for instance, and some of the work we've done on that would suggest that that has distributional consequences as well. And so we've aggregated that in terms of what we've done in terms of the overall.
So I guess that goes to my point, because you did do the analysis on the wage, on the impact on wages from investment boost, and the distributional kind of analysis was done there. And the pay equity, sure, I absolutely accept your point. There is still pay equity legislation, but this budget took $12.8 billion that was set aside in contingent funding away. There is going to be distributional and wage impacts from doing that. So I'm trying to understand why. We're on one side, you're doing the wage analysis for investment boost and distributional impacts, but not for the pay equity changes.
I think to clarify, I mean, in terms of the impact on the economic forecasts, wage growth forecasts, the two policies were treated very symmetrically. So the pay equity change, we previously had an allowance for additional wage growth in there that was pulled out. That has an effect in our economic models on consumer spending and therefore on economic growth. It allowed for reduction in interest rates, and that was all modelled in at the macroeconomic level. And at the macroeconomic level, exactly the same thing was done on investment boost. You've got a detailed assessment of based on the literature on the likely impact on growth. That was essentially plugged into our macroeconomic model over time. So at that overall economic level and on aggregate wage growth, the two were treated very symmetrically.
Yeah, but we didn't see it, for example, in the regulatory impact statement that accompanied the legislation with the changes to pay equity, in the same way that we did see that analysis in the regulatory impact statement that sat alongside the investment boost legislation. But look, I would be interested through this committee in receiving that modelling that you've done around the impact on wages of the pay equity changes. I think that would be useful for the committee to ask for that information. Thank you.
Okay, it's just one sub.
Just one sub, yeah.
Okay, and then we're going to go to Dr. Deborah Russell.
Multipliers were mentioned. I don't have much insight into how Matai works. Could you give us some insight into how the fiscal multipliers are currently configured?
So just as in the real world, the fiscal multiplier really, it depends on the detail. In Matai in general, on average, additional debt-funded government spending has a fiscal multiplier of about 0.5 over, I think it's over a couple of years, which means $1 billion of additional government spending funded by debt would boost GDP by about $500 million temporarily. Of course, we do have enough detail in there to, for example, if the government spending is on items that are all imported, then there's no fiscal multiplier at all. Whereas if it's transfers to low-income people, the fiscal multiplier might be a little bit higher. You have to remember that first of all, additional government spending funded by tax has quite a different effect. So really depends on the details of both. Additional government spending funded by debt has an interest rate response, which is why in the literature multipliers are generally less than 1. So government spends more, yes, that boosts the economy, but you get, or boosts demand in the economy. The central bank sort of offsets that, and the net GDP effect is generally less than 1. So we have a reasonable ability to differentiate between different types of change in tax or government spending to produce estimates of fiscal
Okay, let's leave it there.
It was one sub. It was one.
Yeah.
Let's leave it there. We're going to come back to you, Chloe, if we get time. We'll just, Deborah hasn't had a chance yet. Dr. Russell.
Thank you. I'm really interested in the forecasting around economic growth. Because I think you're forecasting economic growth of about 0.7% per quarter or something. Whatever it was, it's
Subdued.
But then field days felt great, but elsewhere the economy has felt kind of very subdued in the last couple of months. There's a pretty interesting article in interest.co.nz yesterday suggesting, I mean, their line is, and I think it's saying that, warning signs are flashing for the New Zealand economy, but it says, and then BNZ senior economist says, sure, first quarter GDP growth looks set to be strong, but there are clear warnings that the New Zealand economy has hit a brick wall in Q2, despite revenue growth from the agricultural sector. So I know forecasting is really difficult, and particularly trying to do it almost in real time, which is, I know where you're doing it from, and I know you closed off your economic forecast on 7th April. So before this sort of data may be available, can I just get a sense of where you think the economy is heading at the moment? Are you seeing some of those same sorts of warning signs as well?
Yeah, so I think there's a wealth of, as you suggested, wealth of evidence to suggest that in the first quarter of this year, the economy did continue to grow and consolidate on the 0.7% growth from Q4.
Yeah.
So 0.4% is our forecast there, but perhaps some risk to the upside.
Yeah.
As you've observed, yes, there has been a range of data relating to the month of May, which was quite a bit weaker. It's mostly survey data, so performance of services, performance of manufacturing, business confidence, consumer confidence have all dropped away. Time will tell whether that's a sort of a sticker effect from the announcement of tariffs and fear, or whether that remains. Look, I do think it is very much a two-speed economy that matches what we're seeing. The cities, and as Ian alluded to in his opening remarks, are still quite slow, but export incomes in the terms of trade are at highs, and you are seeing that. And I just think it would be really quite unusual if we've got a large interest rate decline. It's still coming through in effective mortgage rates, very high terms of trade, and a lower exchange rate. It would be unusual for that not to lead to a pickup in growth over 2025.
Right. So even if this last quarter is perhaps slower than we might have thought, you might see some easing towards the
some improvement. I mean, we've clearly had a month of of poor data relating to May.
Yeah, and that does allude to what Ian was talking about in his introductory remarks and things. That's the effect of the tariff turmoil, but I'm getting the sense that's settling down a little bit because, the taco effect. But then we've got the impact now of these regional wars breaking out, and the particular Wes, have you started to factor that into your thinking as well? Because that's going to affect all sorts of oil prices and supply chains.
I think obviously, when we get to the Haifu forecasts, we'll be where we are. I mean, I think I think probably there's been a bit of a roller coaster about thinking about the tariffs. I think probably, but I think our point is there's lots of uncertainties. So the tariff pause periods, are going to end soon, and what happens then? Your guess is probably as good as mine. And I think one of the challenges is it's not necessarily what will be announced on a particular day, but it's the uncertainty that you don't know there'll be something different in 24 hours or 3 weeks, and that's the chilling effect issue on both firms and households. And I talked a bit about the channels through which tariffs will impact on New Zealand economy. I thought right here, right now, it's probably less on the direct impact for New Zealand firms. It's more around some of these sort of investment and confidence, channels.
Yep. It's hard, eh? The consumer confidence piece as well, because we know that unemployment is, we know there's 240,000 more jobs predicted over the forecast period. As a function of, I'm not quite sure, I think it's just population growth as much as anything. But we also know that unemployment is predicted to rise a little bit. And again, it's trying to tap into that and a whole lot of consumer uncertainty around because of the uncertainty worldwide. Again, are you picking that up at all? Because the thing I'm seeing, probably kind of living in Auckland, just people are just not spending.
Yeah, I mean, I think, actually Dom and I were in Auckland last week, and we got that message from Auckland businesses, particularly those exposed to, I'd say, that sort of construction nexus, which is manufacturing inputs into construction itself, transport that inputs into construction. Our sense about engaging with the finance sector, with banks, is they would say overall credit demand is still reasonably soft in aggregate. There is a bit of churn as people are kind of shopping around now that fixed rates have all gone generally a bit below 5%, but that overall level is still probably soft, and it's probably soft coming through in, for example, what we're seeing in their cards, etc. So that's part of the picture as well. And the other part of this is we've got to put into context there is a rebalancing of economic activity that's occurring. New Zealand, even we've got current account numbers out today, we've still got high current account deficit. It's lower than it was. And, part of the adjustment between, stronger exports, softer consumption locally is a bit about how the economy gets, essentially better balanced. And that's part of what you're seeing at the moment.
Thank you.
Okay, now did you have one more sub? Because otherwise we've got, what's that? Primary? Okay, we'll go to Barbara Edmonds.
Just wanting to understand the Infrastructure Commission, as you talked about, there's a lot of good work happening there that has been carried over from Grant Robertson to Minister Bishop. One of the areas that I've requested but haven't had a response to is in relation to the financing and funding side of that, because that sits with Treasury, not necessarily with the Infrastructure Commission. Are you able to give an update as to where you are in relation to what you're thinking and the type of advice that you're giving your minister?
And in terms of when you say,
you can do it in a general way, yeah.
In a general way, well, I think firstly, we're seeing a significant pipeline of public sector projects over the coming
30 years. That's the whole point of the
certainly
pipeline.
the next decade. And you see that there's a health capital plan, the government's decisions on the defence capability, plan, schools, housing. So there are a raft of, proposals there. I think our advice has a number of dimensions to it. I said, as I said, in my opening remarks, there's already a very big program of work, and so there's a sort of digestibility issue, certainly for the next, I think, 3 or 4 years. So, whoever is in government, the reality is it's going to be quite hard to layer too much on top of what's already there. So I think that's part of the advice is for governments to think, maybe thinking more about what's happening in the 2030s rather than between now and 2030, which is sort of mostly baked in, unless you want to really unpick a lot of stuff. So there's a sort of longer term dimension to that. Certainly in terms of the fiscal strategy advice that we're providing to ministers, we kind of get them to think a bit about that's, the capital allowances are an important part of the mix. There are also opportunities for other financing options where that makes sense. And for us, it's not one size fits all, or but openness to PPPs where that makes sense. So there's a range of options there. We also have talked previously at this committee about the fact that the Crown's balance sheet is now very large. It's got like $570 billion of assets. So at least one source of funding for some of that capital over the next 10 to 15 years may come from the Crown deciding to use those assets in different ways. So we're certainly emphasising with ministers the importance of infrastructure, that long-term dimension, and not focus too much on the next few years, but also that there's a range of financing options that government should have in the toolkit.
So one second, that's right. So the Defence Minister announced around $12 billion in the defence package and the infrastructure package that you referenced. Has that full $12 billion been accounted for in this budget?
So there's the $12 billion, there's $3 billion or a bit over $3 billion that is in budget 25. There's about $3 billion of that has already been funded from depreciation reserves, and so there's additional roughly $6 billion that'll be have to funded over forthcoming budgets, and that will be built into the capital allowances or equivalent. Part of the rationale for that is that exactly what we were talking about before, to get the quality of the expenditure, so to make sure that all those projects go through a proper business case process and are formally approved before they are built directly into the budget and into the allowances.
So to summarise that, Minister announced $12 billion. This budget has $3 billion. The additional amount that's needed for the $12 billion will be dependent on business cases and will show up in further budgets, but not actually this budget.
Correct.
Thanks. That's true.
Okay. We've got a sub by you.
No, it's
primary.
the question that I've been asked for a while.
Yep, that's right. You go, Chloe, primary, and then we've got Deborah. And then winding up on you. Thank you.
Does GDP growth trickle down?
You'll summarise.
You have a question, no, I have a question.
So I think
It sounds like a pub quiz.
depends what trickle down.
We've got some follow-ups.
So probably, I think the best thing to go back to is the wellbeing report that we published in 2022, which showed over the past 20 years, there's been a substantial change in life in New Zealand has generally improved, was the first finding of that report. In terms of material incomes, I don't have the numbers in front of me because that wasn't what we prepped for, but I think it was a 90% increase in real incomes over that time. In terms of inequality, income inequality on a range of measures increased a bit in the 1990s, early 1990s, and hasn't really changed much since then. So therefore, the evidence is that bottom end incomes and top end incomes have risen really substantially over the past 20 years.
And wealth inequality?
Wealth inequality widened between homeowners and non-homeowners Another way to put that is between older people and younger people, because older people tend to be homeowners. But actually, houses are owned across a wide range of income deciles. So wealth inequality, when measured across income deciles, hasn't changed as much as you'd think. So basically, homeowners have gotten a lot better off, a lot wealthier in New Zealand relative to non-homeowners. That's been a really clear change consequent on house price changes.
I mean, my understanding of the data is that the top 1% in this country currently hold approximately 23% of the wealth, and all other things remaining equal, if we are to pursue a growth agenda without any meaningful new redistributional policies, or to, I don't know, remove ourselves from being an outlier internationally with regard to our tax system, that inequality get better or worse?
Well, I think that's that's hard to talk about in the abstract. I mean, we certainly think that there's a really important role for government to use some of the proceeds from growth and things like education, healthcare, etc. And those are responsible. Those are quite important features to ensure that the benefits of growth are widespread.
And your official advice continues to be that we need a capital gains tax?
Look, if we could go back to, I actually think the first time Treasury went public on capital gains was 1990.
Yeah, before I was born.
Yeah, no. So we're out there.
You're just showing off now.
No,
I'm just showing that I am the physical manifestation of how long we have been politically impetent on one of the biggest economic issues in our country.
We were out there before it was fashionable. It's a bit worrying for Treasury. I mean, I think our point is, I'd say the short answer is yes. Short answer is there's devil is in the detail. So Treasury has always been quite tends to have quite a broad range of assets. I think the other point I'd make is coming back to what is the value from a Treasury perspective of a capital gains tax. I think obviously there's a revenue side, but we actually think probably the bigger gains are around allocation of investment capital.
Yep.
And certainly if you come back to the fiscal position, putting a new tax base in is not really going to help your fiscal consolidation in the next few years. It might be an issue for the 2030s. So I think it comes back to, we'd still be sort of saying, what are you trying to achieve with a capital gains tax? And we think it can certainly be part of the mix, but it'll also be clear in the area of tax. There's no silver bullet. I think our general point, I think I made this the last time I was at the committee, there's a number of structural issues in the tax system that would warrant attention over, say, the next decade. Capital gains, I think, is but one.
I mean, the IMF makes a clear point that it's about productivity. I mean, I want to talk about bonds. But
Okay, last one, because we've got 7 minutes.
I mean, just a really brief one. This might be for Kim. Why are our bonds so consistently oversubscribed?
If you can come to the microphone.
Do you want to come up?
Thank you.
So if you're talking about sort of weekly tender oversubscription, generally through time we do have oversubscription, and that's standard globally. This year in particular, they've been more oversubscribed than usual. And I think investors, depending on where they're based and what they're looking at, will have different criteria. They were looking at our yield, they were looking at the sovereign risk, they were looking at whether they think they can be well traded. And when they top that up, and they're obviously looking on a relative basis, they're obviously making the decision that they find those New Zealand government bonds attractive.
Okay, no, I think we're going to leave it at that. There's always the opportunity to talk after the meeting. So we're going to go to Dr. Russell.
This is a question we went through pretty extensively with the auditors last year in Treasury. And it's around the
What are you most proud
climate change and around the achieving our international and domestic climate change targets. So this is on page 76 of BFU. And it's really around at what point we think, we broadly think we need to actually record a contingent liability of some sort in the Crown's financials. And I've looked up the Crown's accounting policies, which are just distributed recently. You need, it's the point at which you record a contingent liability at the point at which a contingency is evident. And we've had the Minister repeatedly saying that we intend to meet our 2050 climate Paris obligations. It's also become increasingly clear that we're not going to meet those just by, it's always been that we were going to buy international credits in order to meet those. And it's become increasingly clear just in recent times that some of the things that were being relied on locally were not going to come to pass, such as carbon sequestration. Is the entity that was doing that is asking for a subsidy. Yeah, it's getting there. I'm just trying to set up the groundworks for it. And just in the last day or two, the entity which was looking at green hydrogen is saying it can't continue unless it needs some kind of subsidy. So I'm just asking for your thinking around when, so is it becoming more and more obvious that we are going to have to buy some of those international credits? So at what point
Do we book it?
do we book it? And what's the thinking around it, why it's still sitting? It's unchanged in this, in BFU and in HEIFU and from the previous BFU. We've got a HEIFU coming up. I'm just sort of saying, when does this?
I mean, the very short answer is because there's been no additional information that we've received that would lead us to change our view. Sure. But there's an important distinction between the policy side of where the government intends to do and its policy intentions and how we recognise things in terms of accounting standards. And they're different. And so the government's announced what it wishes to do and how it intends to achieve its objectives. But for accounting purposes, the information there does not meet the tests, in our view, of a constructive obligation to meet that liability. I have to say, that's consistently under review. So we're constantly looking at the information that's coming through on the way. And it is something we've spent a great deal of time, as you know, with. But our view is also shared with that of the Auditor General. We've worked constructively with them as well, and they're of the same view as us.
Yeah, so it's not quite meeting the...
No, well, again, it's hard to predict what pieces of information would change that until... But it's at the point when the government recognises that it has no real alternative or choices, or makes a very clear statement that's exactly what they're going to do.
Yeah. Okay.
Yeah.
Watching brief, I'm probably going
Well,
to
no, exactly. We will
See
be
you in
doing
6 months' time.
Perennial.
we'll be doing the same thing.
Asking it for years.
Yeah, I'll keep it asking.
What I can give you the assurance is that we are taking this very
we do.
seriously
Yeah.
and are applying the accounting rules with the absolute clarity
Absolutely.
and with the agreement of accounting standards.
You can prep for that question.
Right.
Next
I
time.
just-
Okay, and then we're going to go to Ryan. Yep, just one sub, Dr. Woods.
Just in terms of the kinds of things you're watching as kind of the temporal aspect of it, part of it. I mean, we know we don't arrive in 2030 and then go out and pay a fine for not reaching our 2030 NDC. That it's a matter of us having engaged probably in bilateral arrangements around what we're going to do in terms of international credits. So is time one of those things that take, I mean, we're getting pretty close to 2029 where it really is going to become even, I mean, surely by the time we get to 29, that you're going to have to be booking it because it's next year. But what is the temporal kind of nature of it playing with them?
I guess part of the answer to that is a government policy one, right? The government will need to set out exactly how it is going to meet that in 29 as well.
So is a big part of it, just trying to understand, still coming back, and I know we've talked about it, so I'm not trying to relitigate it, but the fact that it's not a binding agreement, so that it's really looking for that certainty from the government that it is going to meet it?
Yeah, so the NDC itself is not a legal agreement.
Yeah.
And so it's how the government chooses to give effect to that intent and the clarity about when and how it does that.
Is weather part of it?
Well, that'll be for the government of the day, but at the moment, the government has announced that they intend to meet that.
Yeah, okay.
Whether we do.
Okay, thank you. We'll finish off with our Deputy Ryan Hamilton.
Always blame the weather.
Mr Hamilton.
Thanks, Chair, for your generosity. First question from the government side. We're nearly at time.
That's because the chair was playing on the sofa.
Well,
One sup and
I
one
was trying to be
question.
nice to them.
Go hard hitting, come on.
If I can get it out. On the Crown infrastructure and funding, is this a sup off? Barb raised this, which was around the performance measures, and you can see you've introduced some more performance measures into around that, which is the first time. I just wondered what you learnt through that process of introducing them. And the reason why I ask in the wider context is because we're reviewing performance management measures through the whole Public Finance Act. So I'd just be interested in your thoughts and purview.
Yeah, I mean, I don't have a really good answer for you, but this is work in progress. I mean, I think our experience, and I think of the whole committee in a long period of years, particularly on the capital side, the decision-making has been fraught. One of the things we've discovered is just the core information base about what infrastructure or investments are planned and the quality of those has been extremely variable. Yeah. And so one of the things we have done is to try and get a much better categorization of those. And as you say, some of the performance measures, what they're going to achieve, by when, what time, and get some discipline around those process. I genuinely think we've done a lot better. I think agencies generally have, but I still don't think we're where we want to be or need to be in terms of getting the security. Partly it goes back to Ian's earlier comments, I think, too, just about how much we're spending on capital. Are we really getting value for money for that expenditure? And on the other hand, that is one of the big things that's driving our increases in debt levels. So we need to be very mindful that everything we are doing is absolutely necessary and is the best we can get.
And just finally, what do you think New Zealanders could be most proud of with this budget?
It's a political
That's
question.
a political question.
I think I'll leave that to the Minister.
Okay. Thank you, Mr Hamilton. Very, very nice
That's
try.
why you don't get
Thank you,
questions.
Mr. Hamilton.
Treasury advice that said don't do certain things.
Thank you, Mr Rennie. Thank you, Mr Little.
Thank you.
Thank you, Mr
Thank you very much.
Stevens.
Really good. Thank you.
Enjoy your long walk up the terrace.